Hello again and welcome to our final Level 1 Equity Masterclass session, which is on the all-important equity valuation concepts and basic tools. Now, this particular reading has been in the curriculum for a long time, since back when I started, and it represents some of the most fundamental things that we need to think about with equities. So what is the value of a share? So our focus should be on being able to come up with a value under different scenarios. And you probably, or I would expect to see a question where you've got to discount some future cash flows. So that's where we'll be starting off. Present value models, present value of dividends, most likely, but you can also apply it to the company's underlying cash flows. Secondly, we've got multiplier models, which is where there is a link between the market value of the company, so its share price, to something fundamental about the company. The most obvious one being something like the price earnings ratio or the PE ratio, where you're linking the price per share to the profit per share at its simplest. Now, there are other varieties of multiples that you need to be aware of, but there's also extending that into what we call the enterprise value multiples, where we use a slightly different version of price and a slightly different version of profit, but it's the same basic idea. So we'll work through that. And I should note as well that all of these things, if you think, oh, there must be more to it than that, or this is a bit of a simplification, that is often the case, but we're at level 1. Level 2 is where we really lift the lid on these and we have bigger questions, bigger scenarios. So always remember to keep level 1 in its place. Sometimes it's just providing an introduction to things that then get taken further at the next level. Asset-based models at the end, that is a fairly simple way of working out what a company should be worth. It's looking at its balance sheet and saying what are the net assets. We'll get to that. And when we get there, we are at the end of the module. So starting with our discounting, the dividend discount model, as the name implies, just works out the present value of the future dividends. It's just that the patterns of cash flows may be different. So you might see the following one where you've got dividends for a specified number of years. And I love drawing little timelines. So we're showing time 1 is 1 year from now, or the end of the first year. And our cash flows always neatly land on year-end points in time, which is very convenient. So we've got a dividend we can forecast in 1 year, 2 year, and 3 years' time, and then we will sell the share at a predicted terminal value at time 3. So all these things are predictions, and if that immediately makes you think, well, where do these figures come from? Yeah, predicting is hard, but as is forecasting. But there's no alternative really. If we want to forecast something, we have to put our best guesses down. A perpetuity is where we say there's no end in sight to these cash flows. They are dividends. We're stood here, and we can see a stream of dividends, and they will carry on forever, and they will stay at the same level. So that's often used to value preference shares, because that's how their dividends behave. A growing perpetuity is a bit more interesting and probably a bit more relevant to shares, because we do expect companies to grow, and with them, their dividend paying ability. So we can predict the dividend in a year's time, and from that point we say, look, that's going to grow at a constant percentage forever. So obviously the higher the growth rate, the higher the value. Now that growth may not start immediately, but we'll always make reference to a standard formula, which is when you've got the value, when you've got a year-end cash flow, and then it's going to grow. The present value of that year-end cash flow, which is time 0, is the first cash flow, dividend at time 1, and then to discount it and take account of all the subsequent growth, you just need to divide it by the discount rate less the expected growth rate. And that captures all of those cash flows from time 1 onwards forever, assuming that they're going to be growing. Now, there may be 2-stage growth, which means you have initial or early high growth, but that can't carry on forever. In fact, if you look at your formula, it's not possible to have long-term, forever growth that is higher than your required return. And it wouldn't make economic sense anyway for that to happen. So you might have high growth for the first few years, then it'll settle down to a more sustainable level. So those are the models that we're going to work through. So without further ado, let's move on to the first one. So we've got some expectations of dividends, and we can see them, $3, $3.15. It's just the end of years 1 and 2. And then we've got a 2-year horizon. And at the end of that, we expect the share to trade at $40. I know, who knows what a share is going to be worth tomorrow, let alone in 2 years' time. But that's our best guess. Now, the question might not be, what should the share price be? It might be, are the shares over or undervalued? So this is showing it as a potential exam style question. So we can discount this. We could use the cash flow function on your calculator, or you could go back to what I like, which is just good old fashioned discounting, where you divide by 1 plus your discount rate to the power of the number of time periods you've got to wait for the money. So if we discount that through, you get an intrinsic value, fair value, justified value of 39.77, but the market price is currently 30. So therefore, the price is less than the intrinsic value. These shares are a bargain. So if you were an active investor, a stock picker, you'd want to buy those shares. If you were an arbitrager, we met in an earlier module, you'd want to snap up those shares, but try and do it in a way that takes no risk, which is another discussion. But anyway, those shares are cheap. Snap them up. Okay, so perpetuity now. That was the second one down, where you've just got a constant payment of a dividend, pretty dull, has no end, doesn't do anything interesting. The formula for when you are working out the present value of anything, where that thing just stays constant, is whatever that constant cash flow is divided by your discount rate. And the assumption would be that that cash flow is at the end of this year and every subsequent year. So the value of that preferred share, you've probably seen this in the quant section anyway, is, well, it's 4.75% of the par value, which is 100. It's like a bond. So it's $4.75, discount at 7.5%. Okay. So if the share was callable, now again, you might not have done fixed income where we learn a bit more about this. Callable means that the company, not the investor, can repay the share. Okay. They'll only do that if it's in their interest. If it's in their interest, it's probably because they've got a cheaper source of finance available now. It's not in the investor's interest. So if the share was callable, then it's likely that the value would be lower than otherwise because it's not in the investor's best interest. Okay, now let's move on to factoring in growth. Okay, and it's working out growth where you may have to spend a little bit of time, right? There's quite a lot of information on here. Feel free to pause me for a minute or so and just work out what on earth you are given here. If you don't like me talking over a load of information. If you're happy with it though, this is what we've got. Right, we've got some data from Siemens and we've got the earnings per share and we've got it over the last 5 years. So most recent is at the left-hand side. Always worth checking because sometimes the most recent is at the right-hand side. Sometimes it's the left-hand side. So got the earnings per share and we've got the dividend per share. So there's a bit of rounding in there, but from there we can work out what the payout ratio is, proportion of the profits that were paid out as dividends. So a little bit of variability there. We've got a return on equity, okay, and the return on equity is worked out on your net income over the net asset value, okay, which we presumably is in the background to be worked out there. We don't have that information there. And we do have the share price as well. So we're asked to work out the growth rate. Now there's two approaches to this. One is to just look at what we have experienced in terms of the growth in dividend. So you look at the dividend per share and you say, how much has that grown from 2013 to 2017? And just be careful with your growth, because linking 2 years is 1 periods of growth. So you got 1, 2, 3, 4 periods of growth, but that supports 5 figures. Very easy to get 1 out from that. So we have 4 years worth of growth. Growth links 2 years. The second way of working out the growth is to say, what is a sustainable growth rate? Not what has actually been observed, which is the first version, but what can the company sustain in the long run? And that's the G equals, some people call it G equals RB, or G equals B times return on equity. So this uses 2 things. B is the retention rate. Be super careful here, because that's the opposite of the payout rate. So what proportion of the profits are retained and what return is generated on the company's net assets. So it's thinking, how and why can a company grow? It can grow by making money and by reinvesting that money. So if a company is really profitable but pays out everything in dividends, there's nothing left to grow. There's nothing left reinvested into the company. So you need reinvestment, B, and you need profitability, return on equity. So that's the second way. And they'll come up with different answers. So of course you'll be told in a scenario which to use, but in the real world, that's part of the professional skill, isn't it, in deciding which is more appropriate. So using the historic growth rate, first of all, and a required return of 7.5%. So that's the discount rate. What's the intrinsic value of a Siemens share? Okay, so we want to work out what is called the compound annual growth rate. So we're looking at the first numbers for now. Okay, so G is what growth rate takes you from 3 to 3.7 over 4 years. Okay, so if you like to visualize this, you'd say dividend was 3. 4 years later, it was 3.7. In between, we had a chance for it to grow, which means we factor in 1 plus G, and we do that 4 times, and that gives us 3.7. Okay, so if we work that backwards, we take the 4th root of the ratio, most recent to oldest, and that tells us a growth rate of 5.4% is what we've actually experienced per year. Compound average growth rate. Now, the other way would be to say, what about if we use the sustainable growth rate? Well, what would that be? We need the average retention rate, okay, opposite of payout. So in a year where we paid out 53% of the profit as dividends, we retained 47%. So you just do a simple average of the retention rate, and we also do a simple average of the return on equity figures. So with those two together, we can multiply them and say that the sustainable growth rate for this company, based on its fundamentals, is 8.5%. Okay, now that does lead us to a bit of a problem, because that sustainable growth rate is above the required return. So maths-wise, that would not work. So if we use the historic growth rate, that gives us a valuation of the company of, as shown, 185.7. Okay, now just a little note on this formula. Technically, it is D1, right, which is the dividend at the end of the first year. But often what we end up putting into the formula is a compounded up version of D0, because we don't always know D1. So we have to push it forward a year based on the most recent. So it sometimes causes confusion with the exact timing, but we're not really putting D0, the current dividend, into the formula. its future dividends, but we work it out from the D0 most recent dividend. Now, the sustainable growth rate, we worked out at, 8.5% or something. And as I said, that's bigger than the required return. So that shows, it just flags up a problem, and we might have to go back to the drawing board. That is not actually a long-term sustainable growth rate. So you wouldn't be asked to do something like that in the exam, or if you were, one of the options would be cannot be computed. It just means something in our numbers doesn't make sense, and the analyst would have to go back and think about what it is, because that can't be a long-term sustainable growth rate. Okay, so moving on, we've then got a delayed start to growth, where I always think sketching out a little timeline is really, really useful. So sometimes companies don't initially start paying dividend, like Apple, Microsoft. I'm sure they had far better things to do with their cash than to pay it out to investors, and the investors were happy with that. You don't invest in early days Apple in order to get income. You invest to get growth. So it's reasonable to say that a company doesn't pay a dividend but is expected to do so in the future. So we can expect or forecast the first dividend, $4, and at that point it's going to grow into perpetuity. And we need a return of 10%, and the growth rate of 6% is within that range. That's still quite a hefty growth rate. What is the current or estimated current intrinsic value? So with this, I would always be sketching out little timelines and saying what's happening when 1, 2, 3, 4, 5. So it's in 5 years that we're expecting, or T5 times 5, we're expecting a 4 dividend, and that is going to grow at 6% forever. But what's the share worth today? Now remember, your normal version of this formula is that the value today, or the present value, is the dividend at the end of the first year divided by required return adjusted for the growth rate. So I am moving things 4 years down the timeline, not 5, because my formula would normally look to time 1 for the first dividend. So I'm looking at time 5, so I am factoring in a 4-year delay. Another way of bringing in the 4 is to say it's as if you had a time-travelling investor who was stood at time 4 looking at that future stream of dividends. So we can value the future stream of dividends in their eyes and then bring that back 4 years to the start. They end up in the same place. It's just one probably sits better with you. So if we take the value at time 4, it's that end of year dividend divided by required return minus growth rate, which gives you a share price of 100. But wait, we still have to factor in the 4-year delay. So we can do that through our 4-year discount factor, and that gives us our final answer. Okay, so we've done lots of discounting. We've done our flat perpetuity, we've done our set time horizon, we've done a growing perpetuity, we've done a late start growing perpetuity. So the biggest they can ask you really is the next thing, which is 2-stage growth. And I'll give you 2 versions of working out the formula here, but one may sit better for you. So I'd like you to try this. And whilst you try it, I'll start sketching out a little timeline, and we'll see. Obviously, pause me if you need to pause me, and then we'll look and see if we come up with the same answer at the end. Full solutions at the back, of course. Okay, so let me just show you my way of thinking about this, then we'll come back to the numbers. So obviously I draw a little timeline. There's no end to my timeline. I'm told the current dividend is 5, but if I'm buying the share, I don't get that. That's gone. By the way, we could call that an ex-div share price, and it's our usual assumption. We're not going to get that dividend. We're looking forward a year. So in the short term, growth is going to be 10% per year, isn't it? So we can work out manually that the dividend at the end of the year should be 550. Then it should be 605. And then it should be 6.6, or let's put the other one in, 55. And from that point onwards, it's going to grow at a much more reasonable 5%. So the first version of the numbers says I can take the first dividend and just discount that by what we're looking at, 10%. 15%. So I can discount each of those as one-off cash flows in 1 and 2 years respectively. And then I can take my growing perpetuity, but I note that it starts 2 years late. So I could move myself there, work out the value at time 2, and then remember to discount my answer back 2 years. So that's version 1. I could, and it wouldn't be wrong, and some people just like doing it this way, I could do this and treat all those dividends separately, discount them 1, 2 and 3 years, and then take the next one and deal with my perpetuity by putting in my 10% growth, 5% growth, my mistake, 5% growth, and thinking of that as a 3-year delayed start. I prefer doing it the first way, but you will end up with the same answer if you do it the second way. I would always say try and make it as simple as you possibly can. So let's go back to version 1 of the solutions. Okay, so the constant growth kicks in from time 2 onwards, and then we take that figure and factor in the 2-year delay, whilst also saying I've got my dividend at time 1, my dividend at time 2. I'll get them as well, so don't forget them, and they are individual dividends. Okay, so that's version 1. Or I say, no, I want 1, 2 and 3 separately, and I want my growth to kick in from time 4 onwards. So you're basically, I guess people like this because it makes the formula look a bit more familiar. You've got the 1 plus growth on the top. So version 2 gives you your terminal value starting that 1 year later. So you've got 3 individual dividends, dividend at time 1, dividend at time 2, dividend at time 3, and then this is dividend 4 onwards. And of course, it ends up in the same place. Okay, so that gets a bit messy. There's quite a lot to do there. Best to just sketch it down and keep track of what's happening where. Normally stops things from going wrong. Okay, moving on, we've got price multiples. Now, price multiples, again, are covered in much more detail at higher levels. So this is really an introduction to them. We've mentioned the PE ratio a few times, which is linking the share price to a measure of earnings. So if it's 1 share, it's earnings per share. It's the whole company. It's the market capitalization to the whole company's profits. So we can observe the PE ratio. We can also calculate what's called a justified or an intrinsic PE ratio. And when we're doing that, we're looking into the company and we're saying, what should the PE ratio be rather than what it is? We also need to understand what are the inputs, the levers that can make that increase or decrease what the PE ratio should be. With the other ones, price to book, price to sales and price to cash flow, at this level it's more that we understand they exist and they can be useful to compare something when you're looking at a company's price to something about the company. Maybe for a company that's not yet making profits, wouldn't make sense to do a PE ratio, but it might make sense to understand price relative to sales or price relative to net assets. Okay, so let's have a look at our PE ratio and our justified PE ratio. Okay, now the idea is that your price can always be worked out as the present value of your future dividends. And if we take our assumption, as we just have, that those dividends grow at a constant rate, that gives us a good starting point for what the price should be. Now, if we then divide that by earnings that are for the same time period, so remember that has D1 on the top, end of period dividend. So we have to look forward. So if we divide it by our forecast earnings, then what we end up with is using figures all from the company's fundamentals. We've got what the PE ratio should be if we are comparing the current price, not to the most recently reported earnings, but to the forecast earnings. And that's really important actually to, when you're looking at PE ratios, to check what type of PE ratio is. That is a forward PE ratio, which means that we can just divide the dividend by earnings, which is handy because that is a dividend payout ratio. So it's got a name, so we can put that ratio as something about the company. So if that's a forward PE ratio, it's quite neat to work out. If it is what we call a trailing PE ratio, it means we have to make a slight adjustment, and that's fine, it can be done, more of that at level 2, but it's not quite taking the figures that we've got and making it quite so neat. So what do we need? We need the dividend payout rate. We need R, which is the required rate of return. That's our discount rate. And we need G. Now remember, G equals return on equity times the retention rate. So we can always get retention rate from the payout rate, and we're given return on equity. So it may feel like there's a lot going on, and maybe even that you're going round in circles, but what it's actually saying is with those 3 bits of information, you can work out what a PE ratio should be. But you've got to do a bit of extra work to work out growth. So the growth, we take our long run return on equity and the average dividend payout, 1 minus the payout, not the payout, the retention rate. Okay, so don't do what I did there. Always just double check. Remember, growth comes from retaining profits and from generating a return on those profits. So sustainable growth rate, 6.9%. So pop that into our PE or justified PE formula, and that tells us that this company should have a PE ratio of 32.38. Okay, so if the PE ratio is observed to be above that or below that, it gives us an indication that a share might be over or undervalued. Okay, now be very aware of the way that things move the PE ratio. So if we looked at a company and the dividend, let's say, actually not start with dividends, let's say the required return increased, investors started feeling more risk and wanted a higher return, the PE ratio would be likely to fall. Present value of the future cash flows would feel lower. If the long-term return on equity increased, that's got to be a good thing, more profitable company, that is more likely to make the PE ratio rise, isn't it? PE ratio rise. The dividend payout's a funny one because it actually acts in 2 places. So if the dividend payout increased, then you look at it and say, well, that's going to improve a number on the top of the formula. So does that mean that the PE ratio goes up? Well, unfortunately, it has the wrong effect on growth. So at this stage, we leave that as a bit of a question mark and say it depends. It depends on other things that are going on in the company. We'd need to know more information to know whether increasing or decreasing the payout would likely make the PE ratio go up or go down. Again, we've got level 2 for all of this. Okay, so also within multiples, we've got enterprise value based multiples. Now, standing back, enterprise value is another way of looking at the size of a company that aims to not be swayed by how the company has financed itself. So the enterprise value basically takes the market value of the equity and the market value of everything that's not equity, but in net terms, so it takes off any cash. So that's the market value of net debt. And with this way of looking at things, if it ain't ordinary shares, it's debt. So market cap is all about equity. Preference shares and all other sources of debt all get lumped together, and we net off any available cash, short-term investments as well. Sometimes seen as the cost of buying a company, because you have to buy the shares and you may have to refinance the debt, but you have the cash available to help you do that. Okay, so if we're going to talk about the size of a company in those sorts of terms, we need to take a profit figure that is equivalent to looking at the whole company, regardless of how it's financed. So EBITDA is a version of profit that, as the name implies, is before interest. So it's what's available to all providers of finance. It's before tax. It's also before the major non-cash expenses that can also lead to different accounting policies making profit look different, shall we say. Depreciation and amortization. So EBITDA is also seen as a bit of a proxy for operating cash flow. And if it's not a number that appears on the P&L, you have to work it out from extra information. And if that's proving a bit difficult, you could use operating income as a proxy. Now, no examiner would ever ask you to guess which one of those two to use. You basically use EBITDA if you've got it, but be aware that if you can't get it, perhaps because you aren't given depreciation, you could revert to using operating income as a way of helping you get an answer. Okay, so here's a scenario, and I'd suggest you give it a go yourself. And then I'll run through the solution. So basically, is the stock overvalued or is it undervalued? Based on the fact that we've got an industry average and we can compare our company to that industry average. Okay, so I'll assume that you've had a go or made use of the pause button as appropriate. So what's going to go into our enterprise value? So we are going to need the stock price, the number of shares, market value of long-term debt. Couldn't care less about the book value. That's not relevant here. And we do need some cash and short-term instruments or investments. So that's all going to go into our enterprise value. And we are given for our EBITDA, operating profit, and also depreciation and amortization. So we can do it all and then compare to the 10.2. Okay, so enterprise value, market value of equity, plus your debt, net off any cash. EBITDA, take your operating profit, add back depreciation and amortization, and work out the multiple. And then stand back and think, what's that telling me? So we've got a multiple of 10.45. It's not the profit that we're worried about, it's the valuation. So the number on the top's too big. The value of our company is above what it should be relative to the industry average, if that is a relevant proxy for us. So these EV multiples are used quite a lot as a benchmark when there's takeovers and when the multiple gets higher, maybe it's when there's a lot of activity going on and things are worth quite a lot. But, you know, like PE ratios, they do move up and they do move down. So the final version of valuation is our asset-based valuation, which is where our module ends. So the net assets of the company, remember it is always net assets. Sometimes people look at the total assets. No, it's your total assets. When you buy a company, you're not just buying the assets, you're taking on all the liabilities as well. So it can provide a baseline minimal value. And if the company was being wound up, you'd be looking at basically what can I sell these things for quickly. The assets may have differing values if they are value in use and you're buying it as a going concern. But all of that is really the detail for the scenario that you might be given. But it can be quite hard to work out what assets are worth. They might be quite specialised. There may be intangible assets, which either the accountants don't want to put on the balance sheet or it's very hard to put a value on them, even if you can put them on the balance sheet. And that's what we mean by on or off the books. So is there a big value in the Tesla brand, for example? Well, that won't be on the balance sheet, but it is something that is of value. So that sort of thing can lead to problems with this method. And it does look at the company where it is at the moment. It's hard to project future growth into this sort of valuation. And also, even accountants will say, what we put something at in the accounts is not necessarily what it's actually worth, and that may well be the case. So it certainly gives us a baseline, but for most companies, you're buying the future, not just what the assets are worth at the moment. So there we go. That's a fairly in-depth module, but it's got lots of nice calculations, pulls quite a few things together as well, I think. Valuation, discounting, discount rates, required return, that sort of thing. So hopefully that has helped with providing a little bit of exam focus so you're ready to attempt this for real.